Okay, now let's proceed to our last learning objective, so which will also take the bulk of our discussion for this particular topic or module. So for learning objective E, so we have to identify and explain the considerations of an auditor in planning this time and performing the audit of bank's financial statements. So let's start with the audit plan. Now, in planning an audit of the financial statements of a banking entity, an auditor should include in his or her audit plan, among other things, the following. So first, obtaining a sufficient knowledge of the entity's business and governance structure and a sufficient understanding of the accounting and internal control systems, including risk management and internal audit functions. Next, considering the expected assessments of inherent and control risk. So being the risk that material misstatements may occur, so that is inherent risk, and the risk that the bank's system of internal control does not prevent or detect or correct such material misstatements on a timely basis. So that is control risk. And last, determining the nature, time, and extent of audit procedures to be performed and considering the going concern assumption regarding the entity's ability to continue in operation for the foreseeable future. So which will normally be the period used by the management in making its assessment under the generally accepted accounting principles in the Philippines. And take note, so that assessment will normally be a period of at least 1 year or 12 months after the statement of financial position date or after the reporting date. Okay, so again, so the assessment of the appropriateness of going concern, we normally make it for a period not at least 1 year or 12 months after the reporting date. Okay, now let's go to the first plan. The first one, rather. So the first one that we have to consider in our audit plan. So obtaining knowledge of business. Okay, now in obtaining a knowledge of the bank's business, the auditor should consider the following areas. So first, letter A, as mentioned earlier, the bank's corporate governance structure. Okay, another is the economic and regulatory environment in which the bank operates and the market conditions existing in each of the significant sectors in which the bank operates. Okay, so let us explain further. So why is it important for us auditor to obtain knowledge in these particular areas? Okay, first, now take note that corporate governance serves a very important role or function in banks, no? Since the foundation of the banking business is trust and confidence. So therefore, regulatory agencies like the BSP and the SEC will require banks to have an effective governance, corporate governance structures. So as auditors, we need to understand the bank's corporate governance structure and how those charged with governance discharge or carry their responsibilities or carry out their responsibilities related to the supervision, control, and direction of the bank. Okay. In addition, as auditors should also have a good working knowledge of the products and services offered by the bank. The auditors must be aware that banks could have many variations in their deposit products, loan and treasury services, and are continually being developed and updated by the bank in response to market conditions, such as changes in client preferences and actions by their competitors. So therefore, we have to consider those dynamic or uh, what we call this, no? Uh, Dynamic activities of the banks, okay? So in addition, banks also deal with variety of instruments like letters of credits, acceptances, interest rate futures, forward and swap contracts and options, some of which may involve a certain degree of complexity. And for that reason, the auditor should understand the nature of those instruments and services in order to assess the inherent risk and the audit and accounting implications of those items, so including the disclosure requirements. Okay, now let's proceed with our next multiple choice question, number 8. So in planning the audit of banks' financial statements, so the auditor's audit plan ordinarily includes the following except. So what is not included? So A, Obtaining a sufficient knowledge of the bank's environment, including business and governance structure. So this is included. We mentioned this one. B, obtaining understanding of the accounting and internal control systems of the banks. This is also included. Letter C, considering the expected assessment of inherent and control risk that will contribute to the risk of material misstatement. So this is also considered. So what is that considered during our planning is the type of opinion that we will issue on the financial statements of the bank. So normally, we will be able to determine letter D or delta after we have already performed and obtained sufficient and appropriate audit evidence. So number 8, so incorrect statement, delta. Okay. So letter A, letter B, and letter C are all correct statements. So next, question number 9. The period that should be considered by the auditor in determining his or her audit procedure in evaluating the appropriateness of the use of going concern assumption of the bank's management. So we mentioned this already earlier, no, at least 12 months or 1 year after the reporting date. So answer question number 9 is letter D, delta. Okay. Now guys, in connection with our risk assessment, so we have to consider that there are many risks, no, that could affect the operations of the bank. So many of those risks are being contributed, no, by a lot of external factors. So although those risks are not unique to bank, so we have to understand them on how those risks affect the banking operations, no, or the bank's financial statements. Okay. Now, in your handout, you have table 1-1, so which includes the typical risk associated with banking activities. Okay, but take note, no, these risks are not unique, no, to banks. So because this risk can also affect a lot of our other clients. Okay, so even if not in the banking sector. So but let us discuss some of these risks that are associated, no, to banking activities. So first we have country risk. So according to the description in the table, so country risk is the risk of foreign customers and counterparties failing to settle their obligation. So because of economic, political, and social factors of the counterparty's home country and external to the customer or counterpart. So actually, a country risk is simply a credit risk, so occurring outside the country of operation of an entity. Okay, so basically, country risk is also a credit risk. So, but unique to an entity or unique because it occurs, no, or the credit risk arises from an entity outside of the bank's main area of operation. So one of the controls that the bank can institute not to manage country risk is setting a threshold or limit on the amount of the transaction that the bank will have on that particular country. So let's say the entity is dealing with clients located in country B. Okay, so country B is a different country from where the bank primarily operates. So what the bank can do to manage that risk is that they will set a limit or threshold of the amount of transaction that they will deal from clients in country A. So let's say, for example, the maximum amount of transaction that we can have with country A for all clients there should be up to 100 billion pesos only. Okay, so if the transaction exceed that amount, then they will not engage anymore in transaction over that particular threshold. So you call that a country limit. Okay. Next, we have credit risk. So the risk that a customer or counterparty will not settle an obligation for full value. So this is one of the most important risks, no, that the bank face on a daily basis. So this credit risk arising, for example, from commercial lending may be considered as the most important risk in banking operations. So because the funds that the bank use in lending to counterparties, no, to their debtors or borrowers, are funds that the bank obtained from deposits of their depositors. Okay, so that is why if they were not able to recover the amount lent to other party, then they will be liable now for the depositors in returning their money as well. So that is why this is a very important risk on the part of the bank. So they have to recover the amount that they lend to borrowers so that in turn they can return the deposit, for example, of the depositor, should the depositor need the money or the funds. Okay, so very important risk. So that is why the bank will normally institute a lot of control, like for example, scrutinizing every borrower, okay, or uh, every borrower or debtor before they will release the loan or approve the loan of those borrowers or debtors. Okay, so they have to establish the credit worthiness of the debtor or borrower before they approve a loan. Okay, so otherwise, if that counterparty will not be able to pay, so that would also be a very big problem on the part of the bank. So another example of risk is the currency risk. So the risk of loss arising from movement in the exchange rate. So applicable to foreign currency asset, liabilities, rights, and obligations. So that's why a bank normally will have a dedicated department, not just monitoring or studying the effect of foreign currency in their operations. Okay, so to manage this, what we call the currency risk. Another is the fiduciary risk. So the risk of loss arising from factors such as failure to maintain safe custody or negligence in the management of assets on behalf of other parties. So that's why banks institute the physical control, accountability over those assets, so to prevent this type of risk from happening. So another, we have interest rate risk. So the risk that a movement in the interest rates would have an adverse effect on the value of assets and liabilities that would affect interest cash flows. Next, we have legal and documentary risk. So the risk that contracts, again, the risk that contracts are documented incorrectly or not legally enforceable in the relevant jurisdiction in which the contracts are to be enforced or where the counterparties operate. So to manage those this type of risk, so the bank would normally have a very or should establish a competent legal department, so that will review each contract that the bank will enter into, so to prevent this particular risk from happening or to manage this particular risk from occurring. Okay, so usually the bank will have what we call this pool of lawyers or professional that will cater to this particular situation, like reviewing contracts and even going after some counterparties who fail to honor their end of the contract. So usually in a bank, it will establish different offices, all related to legal matters or legal and documentary matters, or different departments or sub-departments in their uh, legal aspect. For example, there will be a separate department that will review the contract, separate department that will run after counterparties who were not able to honor the contract. Okay, so second, separate legal department to, for example, uh, handle specific or special cases that the bank is under. So this is a very big department as far as a banking institution is concerned. So next, we have liquidity risk. So the risk of loss, so arising from the changes in the bank's ability to sell or dispose of an asset. Okay. Another is modeling risk. So that is associated with imperfections and subjectivity of valuation models used to determine the values of assets or liabilities. So that is why banks can also employ their own experts or outsource some of valuation activities to professionals, so that they can avoid this type of risk. So another, we have operational risk. So the risk of direct or indirect loss arising from inadequate or failed internal processes, people, and systems from external events. Price risk is the risk of loss arising from adverse changes in market prices, including interest rates, foreign exchange rates, equity and commodity prices, and from movements in the market prices of investment. Okay. Next, regulatory risk, the risk of loss arising from failure of the company to comply with regulatory or legal requirements in the relevant jurisdiction. That's why the bank will also normally have a compliance department. So that will review their compliance with different regulatory agencies or requirements of different regulatory agencies such as the PSP and the SEC. So another set, we also have replacement risk. So sometimes called performance risk, which is the risk or failure of a customer or counterparty to perform the terms of a contract. So that's why I mentioned earlier. So usually the bank would have also set up a department, no, or unit in their banking operation that will address this particular situation. We also have reputational risk. So the risk of losing business because of negative public opinion and consequential damage to the bank's reputation. So arising from failure to manage some of the risks that we have already discussed, no? Or from the involvement in improper or illegal activities by the bank or its senior management. So that is why usually the bank will release official statement addressing negative publicity whenever they happen. Okay? For example, there is a news about a bank being involved in a particular scandal or situation. So usually what will happen is that the bank will issue a statement, so clarifying the matter so that it can avoid negative public opinion, okay, and therefore damage to their reputation. Another example, we have settlement risks, which is the risk that one side of the transaction will be settled without value being received from the customer or counterparty. So this will generally result in the loss to a bank for the full principal amount if the counterparty did not settle. Solvency risk arise from the possibility that the bank will not have sufficient funds to meet its obligation, or from the bank's inability to access capital markets to request the additional funds if ever. And finally, we have transfer risk, or the risk of loss arising from the counterparty's obligation that is not denominated in the counterparty's home currency. So the counterparty might not be able to obtain the currency of obligation. So even if they have the means to pay the entity. Okay, so usually this happens if ever the entity is dealing with, for example, a country whose currency is not readily what we call this convertible to the currency that the bank is using. Okay, so these are only some of the examples of risks that are associated with banking activities. You also have to take note that risks may also increase with a degree of concentration of a bank's exposure to any client or customer, industry, or geographic area or country. So we can add that. So we call that concentration risk. Okay, for example, if a bank's loan for portfolio consists mostly of lending to, let's say, real estate companies, then any adverse economic event that will affect the real estate industry can also affect the bank. So thus, as auditors, we also need to obtain understanding of the business and operations of those industries. So aside from understanding the industry of the bank, we have to also understand the industry of their major clients because they can also contribute to the risk to the bank. And then finally, most transactions may also involve more than one of the risks that we have identified here in table 1-1. Okay, so meaning the individual risk set out in this particular table may be correlated with one another. So like earlier, I mentioned that country risk is basically also a credit risk arising from a different country or transaction arising from different jurisdiction. Or another example, the bank's credit exposure in a securities transaction may increase because of increase in the market price of the securities concerned, which is a price risk. Okay, and another example, non-payment or settlement failure can have consequences in the bank's liquidity position or even reputation. So therefore, the auditor should consider these risks and other risk correlation when we analyze the risk to which the bank is exposed. Okay, and also banks may also be subjected to risk arising from the nature or very nature of their ownership. So for example, the bank's owner or group of owners might try to influence the allocation of credit of a bank. Or in a closely held bank, The owners may have significant influence on the bank's management, affecting their independence and judgment. Okay? Or for example, a government-owned and controlled bank is affected by the policy and direction of the incumbent government official. So as auditors should also consider those risks. So let us answer some questions related to that. So question number 10. So which of the following procedures can a bank institute to reduce its exposure from counter risk? So letter A, reviewing the credit profile and history of the potential borrower before granting loan or credit accommodation. So letter A, uh, indirectly only affecting counter risk. So letter A more of addresses credit risk rather than country risk. Letter B, install physical safeguards to protect asset from unauthorized access and misappropriation. So inapplicable also, or inappropriate response to counter risk. So letter C, review every contract to ensure that documentation is complete and legally enforceable in relevant jurisdiction. So letter C is indirectly related also, but letter C is more of related to legal and documentary risk. So the best answer is letter D. So set a limit or threshold of allowed transaction in a particular jurisdiction. So this is one of the controls that I have discussed earlier related to country risk. Next, number 11. The risk that one side of a transaction will be settled without value being received from the customer or counterparty. So letter A is incorrect. So because remember, regulatory risk is the risk of loss arising from failure to comply with regulatory or legal requirements, for example, from BSP. While price risk is the risk of loss arising from adverse changes in the market prices, including interest rates, foreign exchange rates, equity and commodity prices, and from movements in market prices of investment. And letter C, settlement risk is also incorrect. Settlement risk is the correct answer. So because this is exactly the risk that one side of the transaction will be settled without value being received from the customer or counterparty. So number 11 answer is letter C. Okay, so by the way, the last item, modeling risk, is the risk associated with imperfections and subjectivity of valuation models. So that is why earlier I mentioned that the control over this is the bank employing an expert or outsourcing to professional expert when needed. So number 11 answer is letter C. Next, number 12. So one of the most important risks in banking operation which arises when when a customer or counterparty fails to settle its obligation to the bank. So I mentioned this earlier, letter A, credit risks. So one of the most important risks in a bank. Okay, so letter B, it's also important also fiduciary risk. So this is the risk arising from loss, from factors such as failure to maintain safe custody or negligence in the management of asset on behalf of third party. So solvency risk is the risk of loss arising from possibility of the bank not having sufficient funds to meet its obligation. And transfer risk is the risk of loss arising from counterparty's obligation not being denominated in the counterparty's home currency. Okay, so but specifically, so the general description pertain to credit risk. So number 12 answer is letter D. Next, which of the following statements regarding auditor's consideration of risk that may affect the bank is incorrect? Letter A, some risks are interrelated with other risks in such a way that transaction may give rise to more than one risk at the same time. A is correct statement. Letter B, risks may also arise from the nature of ownership of the bank, such as if the bank is closely held or owned or controlled by the government. Correct also yung letter B. Letter C, risk may also arise not only from external factors, but also within the bank's operation. Letter C is also correct. So the incorrect statement is delta. So the bank need not obtain understanding of the business and operation of the bank's client and customer. So we mentioned this earlier when we discussed concentration risk. So we mentioned that auditors should also obtain understanding of business and operation of the bank's clients and customer. So number 13, answer is delta.